Down 65% in 2022. Is CloudFlare stock a buy for 2023? I'm going to answer that question in this video, so stay tuned. The first thing I want to look at is revenue growth quarterly year over year for CloudFlare going back as long as we can. We have data going back to January of 2020, so let's look at that. And we see very nice top line revenue growth near or above 50% going back in each of the quarters all the way to January 2020. So very nice, very high revenue growth. The next thing I want to look at is operating income, and I want to see if there's any economies in scale here. I want to see demonstration that that growth in revenue is resulting in increased profitability, but we don't see that for CloudFlare. We see the opposite. We see as revenue has grown, it's just losing more money in terms of operating profitability. That's not a good sign for investors. Why grow your revenue if all it's going to do is increase your losses on the bottom line? I would think you would work to grow at a more sustainable level to increase this the operating income margin as you are growing your top line. And this is going to be especially more important as the Federal Reserve has increased interest rates and investors are now more interested in companies that are demonstrating profitability. They're not just looking for stocks that are growing fast on the top line, right? They want to see good businesses that are generating profitability or at least making good progress to achieve profitability, which we're not seeing with CloudFlare. The next thing I want to look at is cash flow from operations. A lot of times these tech stocks are able to demonstrate growth in cash flow from operations even though they're not profitable and they're losing money on the bottom line because they like to use stock-based compensation to pay their employees. Instead of paying them cash, they pay them in stock options instead. And we do see evidence here in economies in scale, cash flow from operations rising nicely from negative levels to 38 million in its most recent quarter. So that's at least a good sign for investors. However, when I do see that evidence of the difference between cash flow from operations and operating profits, I want to see how much the company is diluting shareholders and going from 296 million shares outstanding to 326 million shares outstanding. The company has expanded the share count by about 30 million, so a little more than 10% in 2 years, about 5% per year on average, we can say. And that's about mediocre growth in share count for a company that's growing the top line this rapidly. And here, just to confirm our thesis, yes, they are using a lot of stock-based compensation. You can see that growth rising. Look at that growth in cash stock-based compensation up to 54.8 million in its most recent quarter. And then finally, to determine if the stock is a buy, let's look at CloudFlare's valuation, trading at a price to sales of 16.38. The stock is relatively trading at the same price it was before the expansion of the multiple during the pandemic. It's back at the same levels. So, and still a price to sales ratio of 16 is expensive on its own right. Just to put it into context, the S&P 500 average price to earnings ratio, not price to sales, the price to earnings ratio historically has averaged around 16 to 18 PE. A price to sales of that makes the stock extremely expensive. So to answer this question, the question is CloudFlare stock a buy for 2023? I'm going to say no, it's not a buy for 2023. And that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.